All right, today I'm going to be talking about different types of accounts and savings that you can deal with for our personal finance unit in economics. If I can do full screen. Okay, so the first thing I want to do is start off by talking about bank accounts because this can be kind of confusing, especially if you've never had one before. There are three major types of bank accounts that you're going to be dealing with. Checking accounts, which are usually accumulate no interest but have free withdrawals. Savings accounts, which accrue interest but oftentimes have a limit to the number of times you can withdraw or when you can withdraw or things like that. And credit cards, which cost you. Checking accounts are going to be your sort of basic, straightforward bank account that you use to make purchases, especially today when almost everything is done with debit cards. So the way that a checking account works is you go to a bank, you open up, and you usually set up direct deposit through whatever job that you may have, which means that you give your bank information to your job, and your job will automatically deposit your paycheck in there when you get paid. And then you can use the checking account to pay for things either by writing checks or through a debit card or through ATM withdrawals. An ATM being the machine that you go to where you withdraw money. You can then use cash to pay for things. Savings accounts work a little bit differently. The idea behind savings accounts is you put your money with the bank, and then the bank gives you interest over time. This normally represents about the rate that the economy grows, maybe a little bit less. But this way, it incentivizes you, it encourages you to put money away for later dates, for other things that you might need, expenses, and your money will accumulate interest. So say that you get 5% interest annually. If you deposit $100,000, well, okay, that's ridiculous. If you deposit $1,000 in a year, by the end of that year, that $1,000 will have made you $50. The bank will give that to you because when they have your money, the economy is growing, and so your money should theoretically also grow in value. The last account are credit cards, and these are offered by most major banks. These cost you. In the same way that savings accounts accrue interest, credit cards also accrue interest. But the difference is that with credit cards, you start off with nothing. You don't have any sort of cash invested in them, and then you make payments, or then you make purchases rather, that end up being charged interest by the bank. And we'll get into credit cards in a later lesson, but those accrue interest at a pretty high rate oftentimes, and that's how a lot of banks end up making money is through credit cards. So checking account, basic, straightforward. You give your bank, the bank holds onto your money for you, and then you can go spend it whenever you want. Savings account, the bank holds your money for a longer period of time and gives you money for storing it with them. And then credit cards, you are able to make purchases without any sort of initial payment, and then pay it off over time, usually with a certain amount of interest that is charged. Okay, so those are your three basic types of accounts. So let's move into retirement accounts, and I'm going to probably do a larger lesson on retirement later on, but I wanted to give you a really brief survey of what you're going to be looking at, particularly 401ks. When you turn 21 and you have a job, depending on where you work, you will start being eligible for 401k benefits. A 401k is a type of a retirement account that you can voluntarily contribute to from your paycheck. Okay, so say that I make $1,000 a pay period, and I want to contribute money to my 401k. Let's say I go ahead and contribute 6%. Okay, so what I'll be doing is I'll be telling my employer, take $60 out of my paycheck and put it into this account, and then that account ends up gaining interest over time, and then you cash it out after you've reached a certain age. It's a retirement account. The idea being that it will be there after you retire. Most employers, or at least some employers, offer benefits that include 401k matching. Okay, the way that this works is say that you have a 401k. And your employer says, I will match you 5%. So if you contribute 5% of your $1,000 that you make on your paycheck, you are contributing $50 to your 401k. Your employer will match that $50. So now you've actually contributed $100 to your 401k. In most jobs that offer 401k benefits, the employers factor that into calculating how much they pay their employees. So if you are not contributing to your 401k, you are not getting paid the maximum amount of money that you could get paid by this employer. So that let's say you work at Subway, and Subway pays you $13 an hour. Okay, but Subway contributes 5% to your 401k. And so because of that, they're like, we're not going to pay $15 an hour, we're only going to pay $13, and we're going to do 401k contribution. You are cheating yourself out of money if you work at an employer that contributes to your 401k and you do not also contribute. Okay. Contributions to a 401k as well as a 403b are tax exempt, meaning that you don't have to pay taxes on them. So that $50 or $60 you're going to contribute, before it hits your bank, it would normally have taxes taken out of it. Here, those you can opt to have it be tax exempt, which means that you don't get taxed on that money. You still get to keep it because it goes into an account that you ultimately end up with the money from, but there's no tax paid on it. IRAs and 403bs work the same way. These are, again, retirement accounts that you can invest in, that have no that are tax sheltered. They aren't taxed while you have them until you reach a certain age and you start getting cashed out. So like when you're 59 and a half, and you start collecting on these, that's when you'll start getting paid, or you'll start paying taxes. But until then, there's no taxation. Okay, the last thing we're going to talk about is types of investment, and I'm actually going to just briefly go over this. There are three major types of investment you need to know about: stocks, bonds, and mutual funds. We're going to be covering those in a later lesson. I found a Khan Academy video that explains it a lot better than I ever could. The last thing that I want to do is I want to go back. Well, actually, you know what? I'm going to go ahead and hold off on this. We'll save it and talk about that later.